All right, so can you all see my whiteboard at this point? And it says financial planning topic, what happens to my tax rate when I'm suddenly single? Okay, thank you. All right, I'm gonna put this down so I can draw on it. So you all know how that is. So I'm looking down at my whiteboard so I can draw on it. All right, so you're all familiar with this, and we talked last week about the changes, the inflation changes in the tax code and the income bands and how they change. But we want to focus today on the difference between married filing jointly and single taxpayers. And again, the reason I brought this up is because it came up in a conversation with someone, and they said, "Oh, you know, I just didn't realize that my taxes go up when one of us dies." And they said, you know, my tax bracket's going to increase. And the tax bracket, of course, doesn't change. Or they said, no, the tax brackets change. Well, technically the tax brackets don't change, because let's focus on these. These are your tax brackets, right? So they stay 10, 12, 22, 24, 32, 35, and 37. But what changes, and let me see if I can erase this. What changes here, sorry, new. Okay, I'm gonna leave that there. What changes here are the income levels. So let me make this a little bit bigger. So look at married filing jointly. And let's look at these different tax brackets. So most people live right around here in this section, right? The 22 to 24% bracket. You know, some of you are certainly up here, but most of middle-class America is right here, especially today, because of this bracket, right? The 24% takes us all the way up to $340,000 for a married couple in taxable income. And that's the gift of the Tax Cuts and Jobs Act. And I could get into a whole discussion about what happens in 2026. And in fact, I talked about this in May, you know, what happens in 2026 to tax rates. And tax rates change dramatically then. But we're just talking today about the difference between married filing joint and single. Now, take a look. So here we have $340,000 is the top of the 24% bracket. Well, when your spouse dies, you have one calendar year of that. So spouse dies in January, you've got that year where you can still file as a married person. And then the following year, what happens? Well, look at the top of the 24% bracket goes to $170,000. So if the math is really easy, it's half of that, right? So half of $340,000, $340,100 divided by 2 is $170,050. And that's the same here. $170,150 is the top of the 22% bracket. And that drops in half to the $89,075. So what that means is you have less room, right, in that 22% bracket and 24% bracket. And if that doesn't quite make sense to you, remember, think of it as this graduated cylinder. So let's plot out our tax rates: 10, 12, 22, 24, 32, 35, and 37. Now, I'm just going to pull up my own tax rates over here. Give me a second. I'm just going to my website and pulling up the tax rates. So over here, we're going to do married filing joint. And over here, we're going to do single. And we're just going to focus on these areas. So remember, I'm going to the top here. The top for married filing joint is the 22 is 178, 140. So that means if you're spending money, doing Roth conversions, forced distributions from your traditional IRAs, you can go all the way to $178,140 in taxable income before you go into the 24% bracket. And if you're married, you can go all the way up to $340,100 before you cross into the 32% bracket. So that's a lot of travel. That's married filing jointly. Well, once one of you passes, right? One of you RIPs, then you move over to here. And the top of the 22, remember we just said it, goes to $89,075. So if you were filling up this 22% bracket going all the way up to $178,000, and you may not have an option, remember required minimum distributions or what you just need to spend during your lifetime, then you're going to reach the 22% bracket much faster, aren't you? There's about a $90,000 difference. So you're going to go into the 24 and pay, at this point, 2% more for any dollar over that $89,075. I'll tell you a secret though, this 28% or 24% bracket becomes 28% in 2026, and these income levels condense even more. So if you want to go to the top of the 24% bracket as a single filer, which again, you're forced to do, you don't have the option, it's $170,050. So you can see where if you're at $178,000, you're filled up all the 22%, you filled up all the 24%, and you're going $90 into the 32%. So you're certainly immediately paying more tax. Now, will your tax rates double? That's a common thing. As soon as you get married or as soon as you lose a spouse, your tax rates double. Probably not. What happens is your income levels cut in half, forcing your income tax up higher. I don't think you're going to see the doubling there. You're going to see the doubling before we know it, just because of the pressures coming out of Washington, but not immediately when you pass or when one of you passes. Now, what's the big deal about this? Again, the big deal is there are some people who look at these down markets. People look at them two different ways. Some people say, okay, this is a great opportunity to consider my Roth conversions. If my stock accounts are down, you saw anywhere 10, 20%, I can move those funds over to a Roth IRA. And when we get the recovery, I'll get the recovery in the Roth. So that's good. That's a good way of looking at it. Some people say, oh my gosh, the markets are down, my accounts are down. I hear about this recession. I'm a little paralyzed by fear. I want to stop doing my Roth conversions this year. Now that, and then that does a couple things. So first of all, it delays the plan. So any year that we delay gets pushed off to later, obviously, and that increases the tax rate risk. So it increases the risk of taxes being higher, and you just by, again, the pressures of the government, but certainly increases the risk that one of you passes away and you're in the single bracket or the single income threshold. See, I did it myself, while you're trying to complete Roth conversions. And you can see the problem, I hope, here, where we can go all the way up to $340,000 in Roth conversions as a married filing joint tax filer. But we're limited to $170,000 of total income, including conversions, to stay at the top of the 24% bracket as a single filer. So my recommendation is, I know it's scary, but if you have a schedule of Roth conversions, stay with it. Don't let the outside pressures concern you. I know it's difficult to pay the tax at times. It's always difficult to pay the tax. Who are we kidding? I don't like paying my quarterly taxes either. I contribute everything into our Roth 401k, and every now and then I get a little itch in my brain saying, geez, I'd like to move some of that. I'd like to just take a deduction, but I know it's better in the future than doing it today. And it's not always easy. And attending these webinars, attending classes, that helps stay on top of this. So I hope that makes sense. Let me see if I've missed anything else. Yeah, Roth conversions are harder than to do when you're single, and you can't, if you've got, listen, if as spouses, let's say spouse number one spouse one has $1 million in IRAs. Spouse number two has $2 million in IRAs. And you might think, okay, well, it's not so bad, but what happens is, so RMDs in the first year will be about $31,000 here, and obviously about $62,000 here. And people also forget that the typical way that spouses inherit IRAs is spouse number one dies, spouse number two gets that IRA. Now this becomes $3 million, right? That's a 3. And now you've got to add that RMD onto here. So that's $93,000 that you have to take as an RMD. And this, your first year RMD is probably your smallest because the percentage gets larger every single year that you have to take out. So this could quickly become, $150,000. That's assuming you have some growth in IRAs, which most people do. So again, I hope that's helpful. Stay the course, stay with your Roth conversions and your strategy. If you're fortunate enough to still be married, still have your spouse with you, take advantage of this because it happens quickly, and I've seen it too often. And we have plenty of people who come to us. We had a series of widows this year, and they would love an opportunity to continue, of course, have their spouse with them, but just from a tax point of view, to have the ability to continue to convert all the way up to $340,000 instead of being limited to $170,000. All right, let me stop my share here. And we've got a couple questions. Oh, Gerard, good. That's a good point. Standard deduction is also cut. Yeah, I forgot about that. So let me bring back my share. So Gerard asked a great question. He said your reliance on standard deduction is also cut in half. So when you're married filing, when you're a single filer, look at your standard deduction here. Your married is 25.9. Oops. 20. I don't know why it's not letting me draw in there. 25.9. Your single is 12.950. So and if you're over 65, you lose an additional 1,400. So this is 1,400 times 2 if you're married and over 65 or blind, or there's some other, I think there's some other conditions, but you lose that, and your standard deduction gets reduced to 12,950. Really great point, Jory. Thank you. So again, the moral of the story is get it done while you can. In the best, if you are married now and able to file as married filing jointly. Doug asked, what is the RMD basis if you move money from traditional IRAs to Roth IRAs the year you turn 72? Let me think that through for a second. What is the RMD basis if you move money from traditional IRAs to Roth IRAs the year you turn 72? So you're talking about Roth conversions. And let me make sure I'm not sharing anymore. Yeah. So you're talking about Roth conversions, and you have to do any RMDs before you do any conversions. So you want to be really careful about that, because if let's just use, $200,000 as an example. If you converted $200,000 in April of 2022, and you turn 72 in April, then, let's call it that. If you turn 72 actually in any time in the year, you have to take a required minimum distribution. You have to take it by April 1st of the following year. And you might think that gets you off the hook for this, but it doesn't. That RMD has to come out first before you do a conversion. So if your RMD is $30,000 and you convert $200,000, but you do that conversion first, you're going to have to make an adjustment. It would, in your conversion amount before the end of the year. So that's number one. So you've got to do your required minimum distributions before any conversions. Number two is basis. The only time you see basis in a traditional IRA is if you have after-tax contributions, and you've got to pay attention to those, and hopefully you've got your filings for that or your documentation for that. But if you convert, let's just say, out of that $100,000 or $200,000, if $100,000 of that is pre-tax, and you convert that, this gets complicated too, because there's a pro rata rule. So it could be that $100,000 of that is converted tax-free, right? It just moves from your after-tax portion of your traditional IRA to Roth. But if that's not the entirety of your IRA, if you have $1 million in your IRA and $100,000 of it is after tax, that's going to be only about $10,000 of that conversion is going to be tax-free. The rest of it is going to be considered a regular conversion, and you'll have to pay tax on that. And that's known as the pro rata rule with Roth conversions. And again, a very confusing topic, but I hope I answered your question. All right, folks, it's 10:42. That's going to wrap it up for today. We went over some market discussion. We talked about some slot updates, and we talked about what happens when I'm suddenly single in retirement to my tax rates. I look forward to seeing you all again soon. You'll get a recording of this webinar before the end of the week, and you also will get a recording of last week's webinar with Heather Schreiber in the next couple of days. I expect that video to be done in the next couple of days. And I'll either be calling into you all from this location next week or back at my home office, but I look forward to seeing you all again. Take care. Have a great week.